I'm Gord Long with the Financial Repression Authority. It's my pleasure to have with me this morning LeLand Miller, the president of the China Beige Book International, which is the largest and most comprehensive private survey available on the Chinese market. Good morning and welcome, LeLand.
Morning.
I was looking forward to talking to you today because of this whole subject of obviously China, but the quality of data and information, because there's so many different opinions on that. And I think that you're probably the person in the world that would know. But could you give our listeners just a brief overview of your personal background and the China Beige Book?
Sure. I'm a lifelong China watcher who finally decided back in 2010 to do something about the complete lack of data that buy-side firms, that multinational corporations, that governments and central banks had on the Chinese economy. Traditionally, people were willing to rely on Chinese government data. And for many years, that didn't really matter that much because the Chinese would announce their growth goals, and they would meet those growth goals in their official announcements, whether they actually met them or not. And everybody was relatively happy with the levels and with the announcements because the growth numbers were so high. It's a different world now, and I think that one of the things the China Beige Book aims to do is give people a real picture of not just the growth dynamics, but also the labor market, the credit dynamics, the macro implications of Chinese growth, indications of future Chinese demand, implications on the commodity markets around the world. And we try to give people a much better picture of what's actually happening instead of just relying on official data press releases.
Well, we're going to get into it, obviously, in a lot more detail. LeLand, this is part of a series on financial repression that we've been conducting for, about a year now. And we've had some of the finest people in the world join us. But one of the four pillars that we have found in financial repression is something we've referred to as obfuscation of data. That is making, not conspiracy, but twisting the information, spinning it, leaving it out. And so that's one of the reasons we wanted to talk to you, to get a clear perception in China of what they're doing. But could you define financial repression and what it means to you?
Sure, it has a pretty clear meaning in the Chinese context because people talk about reform and restructure and rebalancing, but what reform means right now to China is a reversal of financial repression. It means reversing this long-time economic model where the state would profit through the economic system at the expense of consumers and households. And one of the things that the new leadership is intent on doing in order to create the consumption economy that we hear so much and read so much about is to reverse financial repression, to start empowering consumers so that they'll be able to spend more, to stop empowering state organizations which are fueling the overcapacity and the massive debt bubble. And basically, the term is not used enough, but Chinese reform right now is exactly tantamount to reversing financial repression.
We've got everybody else talking about how it's being implemented as a macroprudential strategy and at the rate, and I'm talking about in the developed world specifically, to hear that. What should investors know about China that they don't, and what's the biggest misconception?
Well, I think the biggest misconception, although it's less so now than it was, say, 6 months or a year ago, is that the GDP number tells you much about how China's doing. GDP is a very broad, blunt indicator that measures aggregate growth. It doesn't measure productive growth. It doesn't measure debt dynamics behind the scenes. So one of the things that we always joke about with clients is that if China wants to hit a certain growth number, say 8% growth next quarter, they can do it. They just build a bridge, tear it down, rebuild the same bridge, tear it down, build a bridge again, tear it down, and keep going until they have 8% growth. It's not a good indicator of what's actually happening in the Chinese system. It's not a good indicator of whether Chinese growth is becoming more productive, whether reform is being implemented. And so it's really important to have other gauges of Chinese growth and credit and labor behavior in order to figure out what's actually going on. Because if you're reliant on just the GDP number could stay high for a long time while things are crumbling badly behind the scenes.
I think that's one of the things that troubles people, investors, is seeing massive pictures of ghost cities being built, infrastructure that isn't being used, and it's a little unnerving. And that's what frightens them about the GDP. But that's not a good measure of what's going on in China, is it?
No, it's among the worst. And one of the reasons that we do China Beige Book so differently is we want to look at it on the ground from the bottom up view of China and adding up all the pieces, GDP is just this very large headline figure, which doesn't tell you what's happening in China, and it doesn't tell you what's happening in different parts of China. So it's becoming more and more useless.
What are the challenges of getting accurate, relevant, and appropriate information on China's economy?
Well, they're obviously huge.
We can't get them, so.
Well, I'm not sure anyone could at this point. We entered at a very opportune time, 2010, and we spent 2 years on the ground putting together China Beige Book. We have survey teams across the country. We have polling outfits set up. They're based to focus on specific regions and sectors. And essentially the way you have to do it is you have to ask Chinese firms and ask Chinese consumers what's actually happening. That has been a very effective way of getting good information. The problem is you have to do it regularly. You have to do it in a very broad way. You can't miss certain sectors or you won't get the full picture of China. You can't do certain regions and not others or you won't get the full picture of China. You can't just talk about growth and ignore the labor market or credit. You can't just do credit and ignore shadow finance. So in order to do this right, you really have to cover the entire economy from top to bottom, and that is quite a gargantuan project to undertake.
Without question, who uses this information primarily, and how do they use it?
Well, traditionally we have two types of clients. The first are buy-side firms, so hedge funds love data; they love this, and asset managers usually use it to allow themselves not to go down a dark tunnel where they're not seeing the light at the end of it. The other type of client we have is multinational corporations. And multinationals are using it to both go into China and more often to expand within China. It gives them an ability to use something beyond official data, whether it's when they're negotiating with the government, whether they're trying to figure out new retail outlets, where to put them, distribution centers, factories. So those are the two core clients. Of course, we share with our friends at central banks right now as well, who are very, very interested in the data, and we now have over a dozen of the largest central banks that we're advising. So a lot of people are getting this information and using it.
What's the data telling you personally now on, or indicating in terms of the economic trends in China?
Well, anyone who's been following China Beige Book knows that for years we have been talking about the Chinese slowdown. We've been talking about it back in 2012 and 2013 when everyone was convinced that either stimulus first or financial or the third plenum financial reform second would reverse this slowdown. It may or may not be happening, and the Chinese growth would stay elevated. We have been talking about this slowdown for years. That it's inevitable. It's happening in our data. So it's been very interesting to see what we've been up to for the last 3 to 6 months, because what we've actually said is that despite the fact that the economy is still slowing, perceptions in the market of what's happening in China have gone from far too optimistic to, over the summer and especially in August and September, far too bearish. And the data that we have do not show this crisis. They don't show Armageddon about to happen. They don't show the Chinese economy on the edge of a cliff. They show a continued mild slowdown. It's a very mixed picture, but it's in stark contrast to the panic that went on in August. So the idea here that China was in great shape, 3, 6, 9, 12 months ago, and suddenly something happened to it over the summer is a very popular narrative, but it's dead wrong.
Well, I remember my old calculus of first and second differentials, and so it may be slowing in China, but if you go around the emerging markets, it's more than slowing. It's dramatic. At least that's our observation as a direct fallout of just the slowing within China. Have you observed that?
Sure. And one of the things that people need to understand is we do not think that a hard landing in China is baked in. There's a lot of people out there who look at the debt and they look at the economic management of the economy and they say China will fail. It's just a matter of, and then fill in the blank, 30 days, 30 quarters, whatever it might be. We're not of that mindset. China is going to slow down considerably over the coming years, but I think its destiny is in its hands. What's interesting though is that emerging markets, other countries, particularly commodities producers, that have been relying on these historic levels of Chinese demand for years and have proven themselves unwilling to factor in not just the likelihood, but we would say the certainty of a much slowing Chinese economy. They are in trouble. There is significant vulnerability among emerging markets, particularly those commodity producers who have simply cross their fingers and continue to hope that Chinese demand will return or it will stabilize at a slightly diminished level. That's not going to happen, and there will be repercussions.
When I look at the GDP numbers, and I heard you about the being aware of the GDP from China as a measurement, but in the context that if I look at the U.S. GDP, we're a 70% consumption economy. But when I look at China, everybody thinks it's huge exports, but it has huge imports, which obviously subtract out. It's capital investment that is a dominant flow in the terms of the GDP number. What's the outlook for capital flows, investment flows in China?
Right. Well, that's actually one of the, if not the critical question right now. And what we said back in the second quarter of 2014, and I think people's eyebrows went up for good reason, is that the second quarter of 2014 may end up being the most important quarter for China this decade. And the reason is we started tracking a broad-based, I would say, collapse in investment spending. Over the course of the next year, starting in second quarter 2014, investment spending dropped in every one of our regions, in every one of our sectors, for every type of firm, and for every firm size. So what we were seeing is a significant drop in capital expenditure across the board. This is one of the reasons why the market happened to be rallying at the time, and we said, look, no matter what else happens in China, this capital expenditure, while healthy for China and healthy for the world, basically ensures there is going to be a significant slowdown that continues in China both this year and beyond, because you cannot have anything compensate for the levels of investment spending that we're seeing drop. It's an extremely important dynamic. We've seen a slight bounce back in the last couple of quarters, but it's more of a stabilization at a lower level. The days of the old investment spending able to move the Chinese economy along are very likely gone.
In terms of attracting capital investment into China, what's this mean for the yuan and the pressures on the yuan?
Well, there's a lot of pressures on the currency. I think there's a lot of people who are of the opinion, particularly after August, that the Chinese currency is either about to collapse or they're about to announce some sort of massive devaluation, because they were trained as China watchers that the Chinese love to play with the currency, depreciate or devalue the currency in order to spur exports and to reignite growth, and that's their tried and true method of getting out of a pickle. That used to be true. That's not what we're expecting right now. Right now, if you look at the strength of the dollar, you could be having a dollar that continues to just go through the roof, depending on a number of factors over the next year or two or three. The yuan is pegged to the dollar, and so as it gets stronger, there will be significant pressures to depreciate the currency vis-a-vis the U.S. dollar, and I think that there's no way to avoid that happening. So this bilateral depreciation. The idea that they're ready to do this double-digit devaluation because of what they supposedly did in August, which was badly misinterpreted, I think is wrong. The Chinese, as part of this battle against to reverse financial repression, are intent on rebalancing the economy. And one of the ways to do that is to keep the currency strong, to provide purchasing power for households, purchasing power for consumers, and allow them to escape this trap they've been in. So I think that the idea that the currency is on a one-way ticket down, particularly against the rest of the world, is very short-sighted, and it's not based on what any of the data we're seeing.
Any observations on the fact that it appears that China has stopped buying U.S. Treasuries with its excess reserves? And matter of fact, it looks like they're actually selling, not at a huge rate, but certainly reducing U.S. Treasuries, which has profound longer-term implications for the U.S.
Well, I'm not sure it does. Where are rates going? What's happening with rates as the Chinese supposedly sell? I'm not seeing the effect that everyone else is claiming to see, because certainly rates aren't jumping here. During short-term stints, when they're trying to manage the currency, when other things are happening, they will sell treasuries. They have to sell some of their forex reserves in order to support the currency. No question about that. Is this a longer-term trend? We have to see. But I think that the problem here is that people have decided this capital outflow issue is this huge issue for China. Suddenly, it's not yet. If we keep seeing this for months and months through the end of the year, then we should start talking about it. But it's very interesting. Up until about 6-9 months ago, all I spent the last several years doing is talking to clients about all the problems associated with hot money inflows. So it's pretty funny that after a handful of months in which the flows reverse, and now you're talking about capital outflows, all of a sudden there's a near global panic on capital outflows out of China, despite the fact that, they have nearly $4 trillion. They have over $3.5 trillion in reserves. They have the money within the banking system. So this is something certainly to watch. But at the same time, this is nowhere near crisis proportions. And I think a lot of the stuff that's out in the media about this is just hysterical.
In rebalancing the economy, clearly the consumer, the Chinese consumer is going to have to take a larger and larger role. What's slowing that right now? Increasing consumption at the household level.
Well, it's moves that do not effectively reverse financial repression like we talked about before. And a perfect example of that would be what's happening and what happened this summer in the stock market. So if we're under the assumption that China overall wants to move themselves away from this financial repression model as much as they can, then what they did in the stock market was a particularly stupid thing to do. What they decided was a good idea was to encourage, and we're talking about in state-run papers, we're writing op-eds saying, jump into the stock market. It's going to be great. So they encouraged households to jump to lever up significantly, and then to jump in the stock market with the effect being to reinflate corporate balance sheets and allow these corporates, which were in big trouble, to roll over debt. Now, true, Beijing probably saw this as the easiest way to get around the problems of getting these corporate balance sheets back into shape. They understand that monetary stimulus is probably pushing on a string at this point. So they thought that this might be a lower cost way of managing the economy. But what you see right here is it wasn't. It backfired. It was managed poorly. The stock market collapsed, and it's no longer a market in any way, shape, or form at this point. And so when you see what happened in the stock market, you see this attempt to, despite the fact that there's an overall push towards reform, there's these problems along the way in which the Chinese go back to their tried and true methods of financial repression, and I think that's what happened in the stock market.
How much confidence should we have in Chinese leadership, current leadership?
Well, the answer to this question, while my views haven't changed, the answer is very different than it was about 6 or 9 or 12 or months ago or 2 years or 3 years ago, because 2 years ago, everyone thought the Chinese were economic magicians. They said, well, 8% growth, 7.5% growth, no problem. We're going to be seeing that for 30 years. And you saw every person, the Chinese government was sent out to talk about the economy, talking about, 30 years of 8% growth. Now people have gone the other way, and they think the Chinese, because of what happened this summer, some of it being fair, like the stock market criticism, some of it being less fair because of misunderstanding around the currency move, have decided that the Chinese are just tripping all over their own shoelaces. They can't do anything right. And I think I would push back on that. So what I said 2 years ago or a year ago would have been the Chinese are nowhere near the economic magicians that everyone thinks they are. They're trying to tinker with this gigantic machinery. No one is that good that they can do this without there being significant headaches and significant mini crises in the future as a best case scenario. Now my answer is, because the world seems to think the Chinese are about to run their economy off the cliff, hold on a second. These guys are no different than anyone else. They're doing some things right. We're tracking a lot of the rebalancing in our data. We're seeing other things that are going the right direction. But at the same time, they're very flawed individuals. And so I think you need to understand that there are positives, there are negatives. They're not all knowing. They're not totally incompetent just based on what happened this summer. And that, people need to look at the trajectory of the stock market more, the trajectory of the economy more than they do the incidence of the stock market to see what I think is the true face of the Chinese leadership, and that is a relatively competent leadership when it comes to economic policy making.
I think that's a very fair and balanced, astute observation, and a correct way. Many of us need to adjust our thinking and expectations on the Chinese. But when I saw the market crashing, if I could use that word, in China, I saw some of the policies that the government came out with. I know one example jumps to mind of really penalizing short sellers and some of the data and information that came out. We talked about it earlier about financial repression, one of the pillars being obfuscation of data, and that is spinning it, twisting it. I know they're trying to reverse it, but can you give us more of a feel of what drives that in China? Is it really changing?
Well, whenever I was talking about the competence of the Chinese leadership, the giant asterisk you got to throw at the bottom of the page is stock market mess was not good. What happened over the summer with the stock markets was absolutely and completely mismanaged. There's no question about that. The first idea that they were going to, again, ask consumers and households to lever up to bail out corporates was a bad idea to start with. Then it was a really bad idea when the government decided to come in and say that they were essentially backstopping the market and were setting a floor. The timing then was extremely bad because they did it the weekend Greece blew up. And then to add that, they realized over time that things were working out, and you started getting leaks about how the senior policymakers had overruled the central bank and other economic policymakers on how to manage this. It was a totally flubbed operation. They're reversing it now. They understand that. I don't think there's any way to defend the mismanagement of the stock market this summer. The caution I would have is that this is not the type of performance that we've seen generally in terms of the management of the economy for the last several years. And what's actually quite interesting, and I completely mean this, is that as many questions as I have over the reform tendencies and the competence of the Chinese leadership, they are proving far more competent than Western analysts' view of China, who have been pounding on the table for 2 years now, since at least the beginning of 2014, to just stimulate more, cut more interest rates, cut more RRR. This has never been a good idea. If you actually see the data like we do, you see that, first of all, the economy doesn't need it. The labor market's resilient. The profit margins of firms are still relatively stable despite the slowing economy. But you also see, if you look at the credit data, you see that stimulus won't work. Cutting interest rates won't work. You've seen real interest rates drop 2 quarters in a row, and yet the share of firms accessing capital has also dropped. So as many criticisms as I would have over how Beijing has managed the economy over the last couple of years, I would say their performance has been infinitely better than the Western know-it-alls who are writing the sell-side pieces, telling people to cut rates all the time. That's truly an effort.
Well said. I think I would agree with that very strongly. Last question, as we're getting short here on time. LeLand, as an expert on China, how would you categorize China's view of America, and is it changing?
Well, you got to distinguish between China's view of America, the Beijing perspective, and how Chinese look at America. I think the Chinese look at a model that they're very interested in taking pieces of. They certainly like the dynamism of the economy. They certainly like a lot of other things and the global power status. At the same time, I think that they do think that we're encircling them out in the south, out in the Asian region. Beijing certainly thinks that, and so there's a very bifurcated view. I think on the one hand, they see us as a model to learn a lot of things from, but also as a serious threat that is looking to constrain their inevitable and ultimate rise. Neither is unfair, but I think at the same time, there will never be a purely good or purely bad view of China. They're going to try to learn what they can from us. At the same time, they're waiting to take their rightful place in the world. At least according to them.
LeLand, we're up against our hard line. Can you tell our listeners how they could learn more about yourself and China Beige Book, where they could get more information on it if they want to subscribe?
Sure. We're trying to become an increasing part of the conversation. We have a very interesting Twitter feed at China Beige Book, which I would encourage everyone to join. We have a distribution list that we're setting up and have set up through our website, which is ChinaBeigeBook.com. That will be sending out increasing pieces of analytical contributions over the coming quarters. Right now we send out a little, but we're going to be doing more over time. So I would encourage everyone to check out our website, to check out our Twitter feed, and to the extent that you might be a client out there, then certainly you can contact us through the website.
Thank you very much for the time, and we'll have to have you back. And when we're looking for the real data on China, we know who to talk to. Talk to you again.
Thanks, absolutely. Bye-bye.